Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today it's Friday. It's December 9th. The market's going to gear up to open up in about an hour and 23 minutes to be specific with you. I don't know where the week has gone. Honestly, I have no idea where the week has gone. I think Wednesday was like, I woke up in the morning, I did this video, next thing you know, it was 4 o'clock in the afternoon. But the markets are up. They closed up. They broke a 5-day bearish streak, if you will, but we're not out of the woods just yet. We've got the PPI today, and we've got a lot to talk about. Now, broadly speaking, the bond market appears, it was down yesterday slightly, it's down today, it appears to be losing its luster. Also, it's grossly overbought, which is telling me that the upside is extremely limited, which is one of the reasons why we're short this stock. So I'm not anticipating a lot of upside surprises from this market. In terms of the news reports, we've got the PPI, which I'll cover in a minute. But the number that I'm looking at, and this report is coming out in about 22 minutes. What I am looking at is the X food and energy, okay? That's the raw. That's the raw number that I'm looking at. And I'm looking for this number. We were at 6.7. They're now looking at 5.9. The lower this number, the better. And as long as this number is below the 6.7, things are moving in the right direction. So again, the estimate is almost a full basis point lower. It's about 0.8 lower than before. 6.7 versus 5.9. That's 0.8% lower. And the expectations are very ambitious, 4.8%. If it's 4.8%, we can see that inflationary pressure is in fact going down. So the Fed may bolster its logic to do 0.50 instead of 0.75. But 0.75 for the next rate hike is actually increasing its odds, as I'll show you right now. So let's talk a little bit about pre-market briefing. Actually, before I talk about pre-market briefing, I want to talk about some earnings. So yesterday we had DocuSign. It did better than expected. Go figure. Broadcom did better than expected. Lulu did better than expected, but their guidance fell short and the stock is down. And I had a lot of big plans for this stock. This stock is a really good company and they're moving up and up. So I wouldn't cut this stock just short. Now, the biggest report yesterday was Costco. And Costco came out with a number that was slightly below estimates. They were looking at $3.14 a share, but they came in at $3.10 a share. They were looking at revenue at $54.67 billion. They came in at $54.44 billion. So they did not beat expectations. So a few smaller stocks did, but Costco did not. Now let's talk a little bit about the pre-open briefing, and we'll kind of see what's on the table, and we'll go from there. I kind of given you the big picture, but let's review this. There's a couple of numbers we need to pay attention to. Benchmark indices snapped a losing streak and closed higher as the market cheered a rise in weekly jobless claims ahead of the U.S. PPI data. That's what I just went over with you right now. The Labor Department report showed that unemployment benefits increased moderately to 230,000, pretty much in line with expectations, which have been around the 220,000 mark, around the 200,000 mark. Unemployment hit a 10-month high. That's a problem, folks. And that's something that the market did not anticipate yesterday. But that's not good. Unemployment is not good. But here's the problem. The weaker the economy seems, the more likely the Fed is to back away from doing what they were doing. So it's kind of, again, where negative news is good because the Fed won't be as nasty towards us. Today, all eyes are focused on the PPI in a couple of hours. Actually, not in a couple of hours, in a couple of minutes. We got 19 minutes left, which is expected to shed more light on the potential path of the monetary policy. And next week, we've got the CPI. Usually CPI comes out first, and they're usually a day apart. They are now, but a weekend divides them. It'll be a very interesting weekend. Economists on average expect the PPI will stand at 0.2 million and a 7.2 year over year. I'm only looking at, I don't care about month over month. I care about year over year. Compared to the previous value of 8% year over year. So they're now looking at 7.2. Now, here's the interesting part, and I go through this with you guys every day. Remember I said by the time the Fed starts taking action, we might see 0.75 at 30%. Well, it already jumped to 25% yesterday. It was at 18, 20, 22%. Now we're back at 74 to 25. Don't be surprised if this goes all the way to 70 or 65 and this goes to 30, 35 before the announcement, especially if today's PPI is not what we're expecting. Also, we're going to be looking at the U.S. Michigan consumer sentiment. That's coming out afterwards. I really would love to see this report come out beforehand, because if the report comes out beforehand, we kind of get a little understanding of what consumer sentiment is like, but no soup for us today. And they're looking at a figure of 56.9. And honestly, in good faith, after the PPI comes out, especially if it's off the numbers, nobody's going to care about what the consumer sentiment report will do. I'm just being honest with you. The Eurex up just a hair, reversing some of the losses. I guess they're following the U.S. market. It was bullish yesterday. All eyes are on the PPI and the CPI and what the Fed does next week. Shanghai closed higher, ending the week in green as the country scaled back several COVID-related movement restrictions. Nice, but that doesn't mean manufacturing is going to pick up 40%, which is what it's down right now. 40%, folks. So yeah, COVID could be behind us, but what about manufacturing orders, right? I mean, at the same time, the Nikkei closed higher, fueled by transports, shipbuilding, and railway. And again, as I said, most of these global markets are looking ahead at U.S. right now. Speaking of U.S., if you look at the Dow Jones, which we will look at right now, you will see that even though the Dow Jones is up pretty good, I want you to see something, and this is important. We broke this low, and yes, we're back in this range, but we broke that low, and we're still below that low. And I think the market's going to cool off and take us to the 200-day moving average. Now, as I say that, notice something interesting. Look at the QQQ. It's below the 200-day moving average, and it's not really moving that much higher. As a matter of fact, to me, it looks like a head, two shoulders forming, and a head right here, and it looks like it's going to break below this neckline and take us lower. I'm not thinking we're going to go higher. I'm thinking we're going to go lower and test the lows. I'm not seeing any massive upside surprises. Bond market looks like it peaked out, as I mentioned. It's down today. It was down yesterday. It looks like it's way overbought. And most importantly, look at the number of stocks in the NASDAQ trading above the 50-day moving average. This is a short-term chart. It's only 2 years. I can even go to a year. So look at where we're at right now and look at where we're going. Every time we peak out, let me show you a 10-year chart. Every time we go above this green line, what happens? We go lower, and we're already lower. We're not even above anymore. We went up, and now we're coming down. We went up, and now we're coming down. 1, 2, 3, 4, and it's happening again. This is not a time to be a hero or to be a big investor in stocks. Now, let's look at each individual sector. When we look at the sector, something interesting is happening. Utilities is now ahead of energies, and technology is ahead of utilities and energies. That's not going to remain that way. That is a real major fragmentation. Healthcare, industrial, consumer staples, basic materials, financial, those are defensive sectors, and energy will join them after it's done pulling back, and utilities already looks like it's coming back up. I would be very nervous about the consumer discretionary, the communication services, and technology, which seems to have been going up. Now, if you look at the vulnerability, and I showed you guys this yesterday, if you look at the vulnerability of this market, let me just show you something. In the S&P, only 55% of stocks are trading above the 200-day moving average. That's nothing. Information technology, 43 versus 81. That's a dead in the water. And here, energy, 22 in the short term, but 61 in the long term, which means it still this is where you want to see the strength, and this is where you want to see weakness. Whenever you see these numbers, and this is important, whenever you see these numbers, the short-term numbers, substantially above the long-term numbers, that means the market's top or real top heavy. And if you look at the NASDAQ, the Dow also 55%. If you look at the QQQ, 46%. 73 versus 46, that's like the opposite of what we're seeing with the energy market, right? 22 versus 61. Here you're seeing 46 versus 71. It's the opposite. And that's telling me that this rally will be erased. Now, I can't say that with 100% certainty, but I'm about 85% certain that that's going to happen. Looking at individual stocks, if you look at my CSI scan, not the short-term one, but if you look at the long-term one, you will see that energy stocks, healthcare and energy, are still leading. The long-term trend has not changed. The short-term trend has changed, but the long-term trend does not change. And when we back-tested this scan, the 12-month, 10-month, 8-month versus 6-month, 3-month, 1-month, the returns were about twice or 3 times as good over 20 years. So I'm following the longer-term one because I think what we're seeing is a major distortion, and market hedge funds trying to make you believe that energy and defensive stocks are done. Meanwhile, these speculative stocks are going to rise. I'm not buying it because we've got a momentum look, and we're seeing that the weakness in the 200-day is real weak, but the 50-day, the short term, is gearing up. That is a red herring. I mean, look at this. Look at this. 46%, and look at this. This is any stock trading above $2, right? Only 59% of stocks are trading above $2. Trading above $2 are above the 50-day moving average, and 42%. So the market is not, I repeat, this is not a bullish market. If you look at all the stocks, not just the large cap stocks, not the NASDAQ stocks, but all stocks trading above $2, only 42% are trading above the 200-day moving average, and only 59 are trading above the 50-day. So things are not nearly as good looking as they may seem to you. I'm expecting bonds to cool off. I'm expecting the Dow Jones. Let's take a look at the Dow. I'm expecting the Dow Jones to continue trading below this channel here, as you could see right here. And I'm expecting more downside in the near term. Now, volatility may be beneficial for us. It's not always bad. It can be good for us because there's potential to make money to the upside and downside. And by the way, even though the market went up yesterday, volatility went up as well. Look, volatility is now at the highest level we've been since the 21st of November. So we're at a two-week high with volatility right now. And I think volatility is going to continue moving higher. Overall, I'm seeing more choppiness, more consolidation, and more monkey business from this market before we start getting clear trends. And with the congestion we're seeing with the with each of these sectors being completely, let me show you this, completely out of whack. I mean, energy here, technology here, really? Utilities, energy, technology ahead of utilities and energies? No, that's market participants trying to fool us into thinking that the worst is behind us. It's not. It really is not. If it was, I'd be the first to tell you. Now, momentum levels, 20-day stocks, only 82 stocks are making 20-day breakdowns. And, let's see here. 82 stocks are making 20-day breakouts, and 114 are making 20-day breakdowns. The number of breakdowns is still outpacing the number of increases, and as I said, I think it's just getting started. And that's after having 4 down days. This market momentum can really go lower, so you got to be very, very careful and be very dynamic. Stay away from interest rate heavy stocks. Start nibbling at energy stocks. I think energy stocks are at a perfect time right now. Matter of fact, if you look at the energy sector, you will see that the energy is now approaching the 200-day moving average right here, or below 50, and it's not overbought anymore. It's starting to get towards the oversold level on technicals like it did here. So we may see a little more break, but I wouldn't be counting my cards that the energy sector is done. I think energies are actually going to go up and make another high, and the stock market is going to go break down. Now, folks, it's been incredible watching this market. I mean, the algos are just distorting everything. And this is why you have to take the time period back, because if you look, like for example, let me show you something. I used to use this S&P scan, 6-month, 3-month, and 1 month. And I realized that the algos are distorting it too much. Look at the stocks that are leading. Wynn, Pharmaceuticals, Las Vegas Sands, Starbucks, Ulta Beauty, going out stocks. But when you look at the longer term one, look at this. Energy, healthcare, energy, all defensive stocks. You're not seeing the same stocks. So in the long time ago, you could use the shorter term time period because there wasn't as many algos that distorted the market. But now we have to look past that noise. So please understand, with 70% of market participants being algo traders, you're going to get a lot false moves. And you know what those false moves do? They trigger you. They trigger your emotions and make you make mistakes. This is why using a systematic approach that fights this algo noise is the best thing to do. But understand, because of algos, I had to change my time period from 6 month, 3 month, 1 month, all the way to 12 month, 10 month, and 8 month to get a much higher accuracy on my stocks. So algos are causing a lot more noise in the short term, and you got to be very mindful of that. Now, folks, it's been incredible watching the reaction to traders using the champion indicator. If you haven't yet, click the link below if you missed the indicator training. It's really cool. We give you so many examples. Chuck and I walked folks through how the indicator works, which stocks it was flagging, the upside, the downside, how it trades to the long side, how it trades to the short side, the average holding time, all that stuff. I strongly, I couldn't recommend it strongly enough. I strongly recommend you watch it to understand how the indicator works. Because if you like what you see, Chuck and I were going live today at 1:30 p.m. Eastern Time, Friday, 1:30 p.m. Eastern Time. If you've struggled to hit your trading goal in 2022, it really isn't your fault. I think you want to get all the details of how to start using the champion indicator today. It'll help you find that edge in the market you've been looking for. Post comments below this video in the YouTube channel, Wealth Press YouTube channel. Send me an email if you have questions, support@marketgeeks.com. I'm always here for you. And follow the link below. I'll see you at 1:30 with Chuck to my left. He'll be there wearing his Hawaii shirt like he always does. I'm just messing around. Follow the link below. Check out the champion indicator training and watch us live today at 1:30 Eastern Time on Friday. Bye. Have a great weekend. Bye.